Hi gang, we're now moving on to preferred stock. While corporations issue common stock, which is the only kind of stock that we've really gone into depth on up to this point, many of the corporations also authorize the sale of what we call preferred stock. Preferred stock is a form of capital stock that receives one or more priorities over the common stock. Usually preferred stockholders relinquish the right to vote in exchange for preference to dividends and preference to assets upon liquidation of the company. Preference to dividends means that preferred stockholders receive their dividends before the common stockholders receive dividends. And we're going to go ahead and take a look at a couple of examples. But first of all, let's go ahead and look at how we record preferred stock. Here you can see recording preferred stock. We're assuming a company issues 500 shares of $5 par value stock, of preferred par value stock. But we charged $15 per share. The company will record the issuance as follows. So cash would be $7,500. Which is the $500 times 15 equals the $7,500. And just like common stock, the only amount that can go into preferred stock is the par value. You put the par value in, which would be the 500 shares times the $5 par value, and then the balance goes into that APIC account, just like we did with common stock. And that would be $5,000. So this is exactly the same treatment we did for common stock, except for, you see, we use the word preferred stock, and that would be the only difference. So let's go ahead and do a sample problem. So we're going to go ahead and look at page 269. And we're going to look at exercise number 7. Exercise number 7. It says a company issues 600 shares of $4 par value preferred stock for $12 on March 15th. Required is to go ahead and prepare the journal entry that the company would record. So the first number we're going to look at is the 600 shares times the amount that we charged for the preferred stock, which would be the $1,200. So 600 times 12 equals $7,200. We then want to do the calculation for the par value, which was $4, and that would be 600 times 4 equals 2,400. Sometimes it's good to just do a calculation like this to kind of let you know what you need to do. And this is a different way to look at it than I showed you in common stock. In fact, you could do it exactly the same way. So this is our cash. This would be our preferred stock at par value, our preferred stock at par. And this would be the APIC, or the additional paid in capital. So we would debit cash for $7,200. We would credit preferred stock for $2,400 and credit APIC, or additional paid in capital, if you want to make it longer, for $4,800. And that is how you record preferred stock. No difference than what we did in the common stock. So let's move on to our next problem, which is, or next topic, is reporting preferred stock. Basically, you're going to see this is the statement of stockholders' equity. Here you see our common stock. When we talk about the par value, how many shares are authorized, how many are issued in these particular days, and right above common stock you would have the preferred stock. Here you see non-issued. If you look at a lot of companies, they have the ability to have preferred stock, but sometimes they typically do not issue any preferred stock. So let's go ahead and take a look at dividends for preferred stock. Cash dividends on preferred stock has three types: cumulative preferred, dividends in arrears, and non-cumulative preferred. When a company has both preferred and common stock outstanding, cash dividends must be allocated between the two. Here are a few terms related to the allocation. Cumulative preferred stock carries the right to receive current year dividends and all unpaid dividends from prior years before dividends are paid to the common shareholder. This is very important. So even though the board of directors is the one who declares a dividend, they may not declare a dividend in a year. A cumulative preferred stockholder is guaranteed a dividend, whether the board of directors declares it or not. Therefore, they are allowed to collect those dividends, and we say they get to collect their dividends in arrears first before their current year and before the common shareholders get to do theirs. And I'm going to show you a numerical example on that. Dividends in arrears are the accumulated value of unpaid prior year dividends. Unpaid prior year dividends. And non-cumulative preferred stock carries the right to receive current year dividends only. So they do not get dividends in arrears. They only get the dividends for the current year. Here's an example. In this particular problem, we have two types of stock. We have common stock, $2 par value at 100,000 shares outstanding. And we have 5% preferred stock, $10 par, 20,000 shares outstanding. What this means in the preferred stock is preferred shareholders get a 5% dividend every year. Okay? If they are cumulative, and that's what the allocation of the dividend will depend if they're cumulative or non-cumulative. And we're going to show you what the calculation looks like. Suppose further that Stover does not pay dividends in 2011 or 12, but declares $64,000 worth of dividends in 2013. The allocation of the 2013 dividend depends on whether the preferred stock is cumulative or non-cumulative. So when we take a look at this, we're going to take a look at how we're going to divide that $64,000, which you see here, between the preferred shareholders and the common shareholders. So the preferred shareholders are allowed or guaranteed $10,000 a year. They are guaranteed $10,000 a year. You're asking yourself, how did we get that number, Rhonda? And we got that number by taking the 20,000 shares times 5%, which is 1,000, times the stock value, which gives us $10,000. So the way that we got this is, there's two ways. We did 5% times the 20,000 shares equals 1,000 times the $10 par gives us $10,000. The other way we can do it is we can do 20,000 shares times $10 is 200,000 times 5%. So the other way I did it was $10 times 20,000 equals 200,000 times 5% gives us $10,000. So every year the cumulative preferred stock owners are guaranteed $10,000 for 2011, for 2012, and then the current dividend would be $10,000. So they would get, out of the $64,000, they would get $30,000 because we first must pay the first year of dividends and arrears, then the second, and then their current year dividend. The remainder is going to go to the common shareholder, which is the $34,000. So even though the preferred shareholder was guaranteed a dividend, they're getting less than the common shareholder, which is one of the advantages of being a common shareholder. Is a dividend is wide open. You don't get just a designated amount. If there's more profit to share and the company wishes to, you get to keep that dividend. However, a preferred shareholder only gets that agreed upon amount up front, but they are guaranteed it, where the common shareholder is not guaranteed anything. So how do we record the declaration? The same thing happens as before. We go against retained earnings. We'll then have a dividend for the common and a dividend for the prepared. Remember that the date of declaration, the dividends become a liability to you. No different than we did with the common shareholders. It's this time the dividend is going to be broken into two parts. Next, when we go ahead to the payment date, again reminding you that at the date of record there is no journal entry, we go ahead and we'll clear the payable and we'll pay out the $64,000 of. This is when, if we were a non-cumulative preferred shareholder with the same dividend, the 5%, you can see here that the common shareholders would have gotten $54,000, where the preferred shareholders only got $10 because they do not get dividends in arrears. So now I'm going to go ahead and do a sample problem for you in a moment. Okay, let's go ahead and try a problem on page 269. And it's problem or exercise number 8. So the first thing we have to do is we have to determine how much the preferred shareholders are due. In this case, its preferred stock is 4%, $10 par stock, and there are 25,000 shares outstanding. So what I like to do is to first get my calculation down, and that way you'll have the number that the preferred shareholders are due. And so like I showed you previously in the other problem a few minutes ago, what I did is I took the $10 par, times the 25,000 shares. And if we do that, we have 10 times 25,000 equals 250,000 times the 4% value that they're going to get dividends based on. So 250,000 times 4% gives us $10,000. So each year they are promised $10,000. Now the board of directors will determine if they want to declare a dividend every 2 years. And in this particular problem, they tell you the 2 previous years, so 1, 2, there was no dividend. So that meant that the preferred shareholders were owed $10,000 each. I'm just going to put a P and a C. No guarantees for the common, so they're not owed anything. So now the board of directors comes in and they declare a dividend for $37,000. So we know that all they're going to pay out is $37,000. We also know that in year 1 they were owed 10, the preferred. They were owed 10, and then they're going to go ahead and get their current year dividend as well. So in this case, the preferred shareholders would get 7, and the common shareholders would get, the preferred shareholders would get 30, and the common shareholders would get 7, which equals our $37,000. So in this case, that is how you would allocate the cash dividend. What I want you to remember is you have to calculate what the preferred shareholders are owed. If they are cumulative, that means they are entitled to dividends in arrears, and those need to be paid before you can pay the common shareholders. And so you must take that into consideration when allocating the dividend. Okay, we're almost done.